We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Craig Hemke from the TF Metals Report. Thanks for joining me today, Craig.
Tom, good to see you. Happy New Year. We're off to an interesting start of the year. It's going to be fun to talk about.
Absolutely. And of course, you recently released your 2023 macrocast, and it provides your roadmap for the year ahead as you see it. So, last year, of course, we reviewed your 2022 look ahead. So maybe let's start with talking about maybe what you got right and what you got wrong as you saw last year shape up.
And 23 follows on last year, really. It's kind of an extension. And it's like there's a timeout or there was a delay. But we're still heading down that same path. And so where I thought we'd be rallying in the metals, I thought we'd dip. I thought prices would dip. I wrote that in, maybe below 20 briefly in silver, and down towards 1,700 in gold. I thought they'd recover and rally into year end, but from a higher level. I mean, they did recover and rally into year end, but I didn't think we'd go down as far as we did because I didn't expect the Fed to continue to hike as aggressively as they have. You could look ahead last year at this time and think, well, last time, 10-year note got over 3% and the stock market fell 20%. The Fed was quick to shift policy. Well, the 10-year note got to almost 4.5%. And at one point, the S&P was down 25%, but yet the Fed was still pedal to the metal. And I think that's probably largely due. Well, one, it's largely due because they're reactive. I mean, they're never proactive, right? They're always rear view mirror people. And so they waited, it was all that transitory stuff, and coming out of 21, half of the goons were still talking about no rate hikes until 2023. And so they waited and waited, then the war started, and then they waited some more, and inflation got away from them. And so then they try to play catch up with all these 75 basis point hikes, and they have no idea. They quantitatively don't know the damage that they've done now to the U.S. economy. And so everything was just kind of put off last year. And now this year's forecast is kind of an extension of what I expected late last year and then to carry over into this year. And so we'll see. I think the historical precedents are there pretty clear for how this will all unfold. And as we discuss this, Tom, I'd encourage everybody I'll send you the link. Maybe you can put the link with the text of this.
Put it in the show notes.
They can go and read it. And I think my site's kind of a shelter in a storm for a lot of folks. I mean, after 12 years, we got a pretty good community of people that we're all kind of rowing together. And I think the analysis that I can provide is important too, but it's not just my site. I think it's very, very important in this year where the lies and the propaganda now is so thick that you really got to think for yourself. People need to go to Palisade's Gold Radio, and need to follow your site for all these independent voices that you bring on. Nothing could be more important than thinking for yourself and analyzing this for yourself and not just being a sheep, swallowing whole whatever CNBC tells you or your stockbroker tells you. You've got to think for yourself. I think my site can help you do that. I'll just tell you now, I made a coupon code of my site. If anybody wants to join us and kick the tires for a month, a monthly subscription is $15. If you check out with a coupon code of 2023, just 2023, you get half off your first month. It'll save you $750. You can check out the whole thing for $750 for a month. Stick around if you like, but if you don't like it, you can punt. But it'll give you a good measure to see if what I do and what my site does is valuable. But you gotta, this is really important that you're thinking for yourself this year, because again, the lies are, and we saw it again last week with the jobs report, the lies are really, really thick and you got to be able to see through it.
Well, yeah, it's not only thinking for yourself, but at least trying to expose yourself to the other side, maybe conflicting ideas and seeing if you think any of it holds water, right? There seems to be a very consistent narrative from one side. And, that's why I try to have so many different voices on my show, is to try and understand where any of our blind spots might be as well. You know, as gold bugs, let's say we believe that gold and silver should always be higher. You know, there's plenty of people that think that manipulation is the only reason that we're in the situation we're in. And I like hearing both sides of that argument.
Sure.
And not necessarily, let's say, in gold and silver.
Sure. And in the bigger picture, again, there's what I call a financial political media complex that kind of circles the wagons and reinforces itself against any threat. You know, they've all got their beaks in the trough. They all profit from a continuation of the system. And so they all prop it up by either outright lying or just having no journalistic interest in investigating. You know, it makes me think, I know you're a competitive race rider, bike rider. So, you know, you remember Lance Armstrong, right? And, you know, you think Lance Armstrong survived. I mean, it was a great story, right? He survived cancer, should have been dead and all this stuff. He comes back. We already know guys like, who's the dude that now lives in Leadville, Colorado? Frank Landis. What was his name? Frank. Anyway, we know all these guys were doping and gaming the system to win the Tour de France. Mm-hmm. Lance Armstrong starts down this path of lying about how he's doing it and wins 7 times in a row. And everybody just swallows it. And again, once you start down a path of lies, you have to keep going. You can't double back. And that's what Lance Armstrong now admits. But everybody wanted the story to be true. I love this story. Oh, Lance friggin' Armstrong. Look at him. He's back from the dead. He's banging Sheryl Crow, man. He's living the life, right? It's great. And it was all a lie. It was all fake, right? But the media had no interest in digging any deeper, even though Floyd Landis is out there and all these other guys are getting, you know, busted for doping. Oh no, he's good. He's got his foundation. They keep propping it up. And that's kind of where we are. I mean, the economic system in the US has been continually propped up with lies now for decades, and they can't go back like Lance Armstrong couldn't go back. You know, whether it's dramatically understating inflation so that buyers of US debt will keep showing up and buying it at 2 and 3 and 4% when they should be demanding 10, but we can't give them 10 because otherwise the whole thing, the Ponzi just spins out of control in interest payments. So they got to keep these lies going. Look at just last week, Tom. They roll out this latest jobs report in the US. Mm-hmm. And if you could Google the term Goldilocks job report and see how many times that was the line. It's Goldilocks. Oh, not too hot, not too cold. It's perfect. Goldilocks. Over and over and over, you go to sites and they say, oh, surprisingly strong and robust U.S. jobs number. More Americans with a job than ever before. Anyone, not just some dope out here in the middle of nowhere like me, anyone can go to the BLS website, dig into the report, and find out that the only jobs being added are part-time. And the only reason more people are working than ever is because they're having to work multiple jobs. This is all right there for anybody to look at. Mm-hmm. But yet that's not how it's reported. Oh, it's 225,000 new jobs. Isn't this great? The way the Bureau of Labor Statistics looks at it, they think if you lose a good paying salaried job with benefits, if you get laid off or fired, and out of desperation, you take 3 part-time jobs because you're trying to feed your family, the Bureau of Labor Statistics in the U.S. considers that a net gain of 2 jobs. Mm-hmm. That's not good. That's not positive. But again, the financial political media complex circles the wagons and they all reinforce this narrative. And that's why it is so important, because as this year comes at you now, right, you're being told, oh, yes, the Fed, they are stalwart in defeating inflation and they're going to do what it takes and they're going to keep hiking rates. And the same bank analysts at Goldman Sachs and the rest that 4 years ago were telling you that 10-year notes going to 5% and the Fed's going to keep hiking all through 2019. They're saying the same thing now. And back in 2019, the U.S. economy began to falter in the first half of the year. And by June, the Fed was cutting rates. And the 10-year note, instead of going from 2.5 to 4.5, like Jan Hatzius at Goldman Sachs said it was going to do, it went from 2.5 to 1.5 by the end of 19. And this year, instead of going from 3.5 to 5, it's going from 3.5 to 2.5. And the Fed's going to be cutting and doing QE by the second half of the year. You can bank on it because the economy's in the toilet. I'm sorry, Tom, I'm going on forever like it's a podcast. But again, I'm getting back to the critical nature of thinking for yourself and not just swallowing, the propaganda that's put forth by the media and the banks and the Fed, because all they're trying to do is keep the plate spinning in their system as long as possible.
Well, Craig, it's an important point. Like, the last time I had Danielle DiMartino Booth on, for example, she was saying that a big part of that number as well is, we see all these Silicon Valley jobs being cut, Amazon, Meta, all of these different jobs. A big part of that, let's say those people not being counted as losing a job, are people that are still on severance pay, right? Getting severance packages. That's still counted as receiving some type of benefit. So as you say, that's a really important way to think about the way that these things are being interpreted. And, Powell is so fond of saying they're going to be data dependent. Well, garbage in, garbage out. If you're taking garbage in, these metrics that they use, if they're flawed to begin with, how can we expect them to be reacting properly to the correct information? Yeah.
Well, there's a narrative to be promoted, right? Mm-hmm. But at the same time, Powell is the chief goon of all the goons on the FOMC. And he was one of the guys 15, 16 months ago saying they were going to keep rates at zero until 2023. Mm-hmm. And now here we are. He's one of the guys saying, we're not going to be cutting rates this year. Cash Gary is another one. Goon Bostic's another one. You go down the list. They were all, it's transitory. Don't worry about it. Then they get behind the 8 ball and they start ramping it into this great unknown faster than they've ever ramped rates before, and assume there's not going to be any impact. The latest, every quarterly meeting, the Fed meets 10 times a year or whatever it turns out to be. But the ones in March, September, June, and December, they put out what they call a summary of economic projections. Mm-hmm. Where here's what inflation is going to be, and here's what GDP is going to be, and the employment rate. And they're always wrong. You know how many of the last 8 recessions the Fed has predicted? 0. They're always optimistic. Bostic this week said the base case for this year is 1% GDP and no rate cuts. And this is the same idiot that a year ago said the base case was no rate hikes, and 5% GDP. They're always wrong, right? You know what is correct? Macro data that, again, anybody can follow this stuff, whether it is the private sector purchasing manager indices, which is like ISM puts out what's called a PMI. S&P Global used to be called Market. They put out these PMIs. When they fall below 50, it's considered contraction and recession territory. They both put out 2 separate PMIs, a service sector and a manufacturing. So there's ISM, S&P, service sector, manufacturing, all 4 of them now below 50. Mm-hmm. The Fed regional banks all put out manufacturing purchasing manager indices, PMIs. Chicago Fed, Philly Fed, Empire State Fed, all of them are below 40. Those PMIs, as opposed to the Fed being over 8, you know what the PMIs are for the last 8 when they get negative? 8 for 8. Tom, they're betting 1,000, brother. Then you think about the yield curve, right? 3-month treasury bills exceeding everything, all the way out to 30-year long bond. Mm-hmm. Inverted yield curve. That's about 8 for 8 as well. So certainly at least the last 4 for 4. All right. So you can either believe
to be predicting a recession. Yeah.
So you can believe the spin. You can just go from headline to headline, reading Twitter or following, what BNN or whatever it's called up in Canada, CNBC here. Again, you can think for yourself. And so let's apply this to the economy and Fed policy and the metals. Again, where there's 2 most recent years that are analogous to this year. One, you got to accept the fact that the whole financial paradigm changed after the great financial crisis, when in March 2009 the Fed began QE. Mm-hmm. And said, "Oh no, they rolled the Bernanke out there," and he says, "We're not monetizing debt." Wait a second, you're buying treasuries, but we're not Okay, fine. All right. So coming out of 2009, QE was a one-off. It was never going to be done again. The little expansion of the Fed balance sheet was going to go back to normal, whatever it was. And everybody bought that hook, line, and sinker heading into 2010.
Well, Craig, let me interrupt you for just one second
go ahead.
here.
No?
This is exactly one of the points that I wanted to touch on with you is the Fed's pendulum. Their swings becoming wider and wider instead of narrower as a pendulum normally ends up.
Yes.
As a pendulum would naturally function, right? So this is
that was a metaphor I put in that macro cash.
And I try not to interrupt my guest, but this is
no
exactly it explains it perfectly.
Very important to understand. I even saw on Twitter this week something from Jeff Gunlack saying basically the same thing. A little bar chart, if each QE program gets bigger and bigger. And why is that? The continued expansion of the debt and the exponential growth of the existing debt. So it just follows that every QE program's got to get larger. Mm-hmm. And this is one of the keys for later this year and next. As we've had these QE programs and these shift, when the Fed is revealed to be full of garbage and the curtain gets pulled back, we've had gold run up and then come back down. Had the shares run up and come back down. Mm-hmm. Because, the Fed, they're being responsible. It's going back to normal, and all this stuff. One of these times, people aren't going to believe them anymore. And they're going to go, and it's going to be like, before I get back to what's analogous, we could also go back to the late 70s. Mm-hmm. You come off the gold standard, demand for gold soars, and it's been underpriced for all these years, and it goes from 35 to 200 by 1975. Then it goes to 100. And everybody's like, well, that's over with. And then what happened? Goes to 900. Okay. That's an analogous period here too, and for people in the mining shares, I've got charts and tables people have sent me of shares that went from 40 cents to $40 mm-hmm. in 79 and 80, because, the gold price went up 8-9 times. Anyway, I digress. But that was a period when it got away from them. Right. And and I don't believe the Fed is. And so one of these times that's going to happen again in the current day. But back to the analogous periods, we exit 2009. I started TF Metals Report in 2010. So I was paying pretty close attention back then. And everybody thought, do you remember, Tom, how often the term green shoots was used? Do you remember that one?
I don't know.
That may be back before your time. Old farts like me will remember coming out of the financial crisis in 9 into 10. The drinking term was green shoots. That out of the rubble and the disaster, and the conflagration of the financial crisis, these green shoots were emerging, right? The new economy, it was all green shoots. So in 2010, everybody thought it was a one-off, blah, 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 blah. Well, guess what? The economy initially jumps and then it starts doing one of these deals. And what happened? November of 2010, after it had been hinted at for a couple of Fed meetings, here comes QE2. How did the metals trade? Okay, everybody's dead wrong. Fed's still in the game, it's getting bigger. QE2 bigger than QE1. Metals kind of go sideways the first half of the year, and then boom. Silver goes from like 18 to 30 in the back half of the year. Gold takes off as well. Okay. And then most important to remember, everybody knows what happened in 2011. Okay, when they are pedal to the metal again. Okay, fast forward. They play all these rhetorical games from 13 to 18, quantitative tightening, Operation Twist, all this crap again about normalizing the balance sheet and rates. It's all lies by that group, that financial political media complex to try to keep the plate spinning. We get to 2018, stock market's crashing, 10-year notes up over 3%. And in late 2018, the Fed begins to pivot. Though as we enter 19, all these bankers, all the investment banks, investment houses, Goldman Sachs and the like are talking about, Fed's going to keep on hiking, 10-year notes going to 4%. What happens? First quarter, a couple quarters of 19, the economy tanks. Fed begins to hint that they're not hiking anymore by March. And by June, they start cutting. What do the metals do? They go sideways for the first half of the year. And then boom. And then in 2020, you couldn't see COVID coming and all that stuff, but new QE and boom, they really take off, right? Mm-hmm. 14, what silver was 14 in 2018 goes to 30, right? Gold was 1180, goes to 2100. Okay. And again, what happened? the curtain gets pulled back. Everybody figured out, oh, wait, the economy's in the toilet. The Fed has to make a choice between these rhetorical games and the peekaboo of, normalization, all this stuff, and saving the economy. And that's now what they're going to have to do this time. Okay. That's why I started with all the stuff about the job report and the PMIs. The evidence of this faltering economy is there. It's going to become more clear as the first quarter and the second quarter unfold. By the time we get to summer, they're going to be talking about not just a pause, but beginning of rate cuts. And by the end of the year, rates are going to be dramatically lower than they are now, not dramatically higher as, the head in the sand, agenda pumping investment houses would have you believe. So anyway, this is all what's in that forecast. It's the basis of my annual forecast. Please read it. And again, use this information to think for yourself and plan ahead so that you're not caught flat-footed chasing and all that other stuff.
Mm-hmm. I think an important point that really matters to a lot of people here this year, obviously, is inflation, Craig. And, I want to get your thoughts on, maybe we'll start with how the base effects right now are painting a rosier picture, that year or month over month comparison to a year ago, how that is starting to help, quote unquote, ease this illusion of inflation coming down. Well,
it's going to, I think you see the numbers of the money supply contracting. And again, the Fed, it has its natural effect. You raise rates, it soaks things up, soaks dollars up. Any bonds they do sell, right? They're bringing dollars back in to the Fed. They're reducing the money supply. And so there's and an economy is slowing. And that, that impact on the demand side of supply demand, that helps lower price too. And so as we record this, the next CPI in the US, consumer inflation report, is due on the 12th. Mm-hmm. It's probably going to come in less than expected. And if it does, probably pretty good for the metals when it does. Inflation, look, there are a couple of things people need to know. And again, this is all part of the spin. What if inflation comes down to annualized 3% or something? It's going to take a while for that to happen because, as you mentioned, you've still got, your month over month or year over year is still going to include all these really high numbers from last summer. So it's going to take a while. But when those start coming off the board, by June or July, that annualized rate is going to fall really fast. Mm-hmm. Important to remember that this doesn't mean we're resetting prices back down to where they were 2 years ago. Mm-hmm. It just means that the further increase from here is going to be a little slower. And the Fed, recognizing the slower economy, all of a sudden, what you're going to start hearing is, hey, look, Fed funds rate is 100 basis points, 200 basis points above the CPI. Hey, we won. We can declare victory. Mm-hmm. And that'll be another part of their rationale for then reversing course, trying to save face, trying to keep their credibility and saying, well, look at that. Inflation came down so fast. We did such a great job of hiking rates. We killed inflation. Now we got to deal with the economy. Anyway, that's when, again, why by summer, the discussion is going to be cutting rates, if they're not already cutting rates. Mm-hmm. And that inflation part of the picture, as you mentioned, the month over month is going to come down. And then you start, think of it like a moving average. You start replace this April with last April, this coming May with last May, June out, new June in. And that year over year is going to come down and suddenly it's be way below the Fed funds rate. And that's going to give them the cover to start cutting.
Well, so let's maybe stack another idea about inflation on top of that. Obviously, China is starting to reopen here. And how do you see that starting to weigh into, let's say, demand for oil, demand for commodities, and the effect of that inflationary pressure on prices and demand on commodities throughout the world?
You mentioned my forecast for last year. There's a whole section in there about what's called the Chinese credit impulse, because it was expected. Why would you expect China to keep going down this moronic zero COVID path, right? It didn't make any sense. So everybody thought, well, that's going to come off in 2022 and the Chinese are going to be back and they're going to be selling dollars and buying commodities and trying to put their people back to work and all that. It didn't happen until December. So that's just been put off. And you look, Tom, now, I don't know if you've seen or anybody listening to us has seen, if you seen copper just since the first of the year? Copper's up over 8% in the first 7 trading days of the year, and north of $4. And holy cow, looking pretty salty. Factor then, take that just copper alone picture, not all the other base metals, you throw them in there too. Global copper stockpiles over the last 10 years have fallen by 80%. That's Shanghai, London, New York, Dubai, wherever that's stockpiled, down 80%. All right. Now all of a sudden you got all this demand coming back. What's going to happen with copper? You mentioned crude oil. That's another one. What's going to happen the next time crude oil goes up? Is the U.S. going to drain the rest of its strategic petroleum reserve? Just dump the rest of it? I mean, we are. And then you throw on the fact that the Fed pivots and the dollar comes down, and that gets the machines buying all the future contracts and everything else. And we're probably on the verge of, even within the confines of the current system, very powerful commodity bull market this year. But then you throw on, again, not just copper, zinc, lead, aluminum, nickel. Those global stockpiles are all falling. They're the lowest they've ever been on the LME. What if some of these rehypothecation and leverage schemes of physical commodities, where in China, copper is used as collateral in loans. So it's been levered up multiple times, tens of times. What if, all of that starts to be on a rather shaky ground? So yes, that China coming back online and their demand, and third world demand, if you want to call it that, that's a big part of the picture this year. And then, hey, one more piece of that puzzle. How about all the stuff Zoltan Posar's been writing about the remonetization of commodities, whether it's gold or tying oil to gold, and offering some other platform where that then is convertible to gold in Shanghai, and what are the Russians going to do? And did you see the story back on New Year's Eve about the Russian sovereign wealth fund has doubled their allowed holdings for yuan and gold, where it used to be 30%, they could hold up to 30% yuan and 20% in gold. Now it's 60% yuan and 40% in gold, which basically means that, there's an example of a adversarial central bank that wants to move all their assets, conceivably, totally to yuan and gold. Well, where's that? What does that tell you they're headed? So I'm sorry if I keep itching my nose. That little coughing spat made my nose run a little bit. But all these pieces, again, I keep coming back to this. And I don't mean this as a form of pimping my site. I'm pimping your site. I'm pimping Zero Hedge. I'm pimping all my friends that do great podcasts and put out great newsletters. This is the time that you have to educate yourself about what's going on, because this is the story you're being fed as 2023 begins is 180% out of phase with how 2023 is going to play out.
Yeah, that's a great point, Craig. And that's why I try to have these discussions, because there are so many pieces to this puzzle that we're trying to layer on top of each other. A good example of that is, let's say, the IMF recently projected that a third of the world will see a recession this year. So can that outweigh China's demand coming into the market by the drop in demand of all these other countries going into recession?
Yeah. Sorry, go ahead. Yes.
Go ahead.
No, and that is the more fundamental case as to why crude oil's come down to $75 a barrel or whatever, right? And there's no doubt that's happening. Yeah, I saw that IMF and the World Bank cutting all of their growth projections earlier this week for the world. But again, put that in contrast to what these central bankers are trying to spin to you, right? Oh, yes, the base case is 1% GDP growth in the U.S. and higher interest rates. Right. What? Those are two completely different points of view that they're trying to tie together into make it somehow some coherent strategy. So, yes, slowing economy, that does impact demand, right? Can it overcome China coming back online demand, that kind of stuff? Can it overcome what do they call it, photovoltaic demand, for silver? Can it overcome the demand for uranium, as alternative sources of energy are pursued? Can it overcome the demand for lithium and some of the base metals, to make batteries? Is that inelastic because of all of those reasons, that demand? And then you throw on again this ultimate guaranteed shift of central bank policy into loosening, printer go brr. And again, it's a recipe one way or the other for higher prices. And then in a world that has taken physical commodities and levered them, and the fancy securities industry term is rehypothecated them. If they get called to the carpet and that leverage gets unwound, like we've always talked about with gold and silver, how many, just on a base case, there's, what's the number? 300 million ounces of silver allegedly in the COMEX vaults. And there's 700 million ounces of open interest. And, even if you assume every single ounce is available for delivery, if all 700,000, where does it come from? Right? That sort of thing. Mm-hmm. That's just the example. That's a very basic example of the leverage in this system, that you can take 300 million ounces and lever it up to 1 billion ounces or whatever, because they know people aren't standing for delivery. Well, if people stand for delivery, if demand, and I'm not saying on the COMEX, I'm just talking about continuing to drain these stockpiles. The charts are in that report of mine. And all of a sudden, there isn't any left. I mean, what about the vaults of silver in London? Ronan Manley's been writing about that at Gold Bullion Star like crazy. Mm-hmm. How many ounces are left in London that aren't pledged to the SLV, right? And aren't a part of, maybe not up for sale. And those vaults just keep dwindling and dwindling and dwindling. What happens when they're gone? So anyway, I'm sorry,
Craig. Yeah, I mean, that's a point that I wanted to get to is where do you think that this, we always hear about the supply deficit in silver. We mm-hmm. saw thousands of tons get drained from the COMEX last year. Mm-hmm. When does the rubber start to meet the road? When does this shortfall in supply and this massive demand start to actually affect price?
The first thing that comes to mind when you ask me that, Tom, is the question I've been asked for a dozen years. When will the banks get out of the bullion banking and the precious metals business? Was last year, was the $1 billion in fines and the 5 convictions and the head of JP Morgan's precious metals desk going to jail, was that enough to get them to stop? No. I mean, there's still money to be made, right? So this condition, this system, the scheme is going to persist until it doesn't. It's going to persist until the very last day. And then one day, there won't be any metal. Somebody will show up, there'll be a delivery failure. Whether it's in, somebody with a forward contract in London that can't get metal anyplace else, and, they can't get it, whatever, they can't get it out of the SLV or whatever. That's when that'll be the straw that finally breaks it. And then, the thing kind of reaches kind of a critical mass, and then this forced unleverage finally comes. But until that's why the physical picture is so important. Until that physical picture finally forces an unwind, then this system of these derivative contracts that are traded, and then the price that's discovered through the trading of the derivatives is where they try to deliver physical metal. That connection begins to fray when you can't deliver the physical metal. And until that happens, this little system over here continues. So I don't know if did that answer your question? I can't even remember, Tom, at this point, what your original question was.
Well, Craig, that brings up an interesting point to me, because I'd like to push back a little bit on that if I could.
Go ahead.
We haven't ever seen a delivery failure on the COMEX, right? The seller is responsible for the terms of that contract. They can deliver in cash or settle in cash instead of physical. It's up to them. So, we think about this, what you said, this delivery failure, but does that end up fraying that piece that you're talking about really the confidence in the ability of the system to continue to deliver even the cash or just the confidence to be able to have that as a mechanism to keep trading those contracts?
I'm really glad you asked me that, because there are still, you can find this on the internet, people say, oh, the COMEX is going to crash in March, in September. And I'll admit, back in 2010, I fell for that too. Okay. This delivery failure is not going to emanate from the COMEX. Not going to. Hell, this month, apparently January must be a delivery month for platinum, because all of a sudden there were 3,800 COMEX platinum contracts that were still open when that contract went off the board at the end of December. 3,800 doesn't sound like a lot. And 50 ounces per contract doesn't sound like a lot, but that's about 200,000 ounces of platinum, allegedly standing for delivery. You know what the total open interest is? I'm sorry, the total stock of platinum is in the COMEX vaults? 160,000 ounces. How's that going to work, right? But yet here we are. They've processed 3,000 deliveries and platinum's still trading. And nothing has changed. I mean, it's not like all that metal left the COMEX vaults. And that's how it's always worked. They just play this circle jerk of warehouse receipts and warrants and all this stuff, or maybe you settle it in cash or whatever. Okay. This current example of what's going on in platinum here in January 2023 is an example of that's not where the failure is going to come from. That's why I cite these global supplies in China, in London, the true physical markets. The new COMEX is just a futures platform. It was never intended to be a physical delivery system. Kind of became one a little bit in 2020 when the whole system really had problems in March and April, but that's a whole other story. The point is the delivery failures where all of a sudden, some big company, Nokia shows up, or I'm just picking one off the top of my head, demanding they put in an order for, some mass quantity, metric tons, thousands of metric tons of silver, and they're not getting it. And so now all of a sudden their supply chain is all gummed up, and they got to halt production of, some company got to halt production of solar panels or batteries or something because they can't get it anymore. That's when it starts to hit the fan. And it doesn't have to be in silver. Again, it could be in copper. It could be in platinum. It could be in palladium, where then market participants figure out, whoa, wait a second. I don't want any part of this.
Kind of like the nickel squeeze we saw.
Right. Yeah. It's a great example. And then you get to a point where the banks that still play these games, whether it's Bank of America or Citigroup or JP Morgan or whatever, and they profitably play these games on their trading desk, shorting because they know that they can outlast the specs, and that sort of thing, the way they always have, they stand back and they go, finally, somebody steps in and says, we can't do this anymore because we can't keep supplying the paper contracts, because ultimately we're the ones that are on the end, we have to deliver metal that we don't have. We're just taking the risk, just like the specs are always taking the risk by being long on margin. We don't have the metal to back these things up. We don't have access to the metal to back them up if we get called on them. So we got to stop playing. And that's how a physical metal shortage eventually translates itself into a change in how the metals themselves are priced. Now, again, this is a fun discussion. It's, academic, thought-provoking, all that kind of stuff. This is not the basis of my forecast for this year and next. The key for people to understand this year and next is that all of these pieces fit together of a vastly weakening economy that the Fed and the other central bankers have no idea. They've never done this before. They've never done QE. They never cut rates to zero. Never jacked them up to 5 before as quickly as they have. They have no idea what the impacts are. It's not like they can fall back and go, well, in the past 20 times this has happened, it's worked like this, and they stroke their chins. They have no idea. All they can do is look backward. And by the time we get into March and in April and May and June, the devastation is going to be obvious, and then they're going to be forced to shift course. They'll declare victory because they got inflation below Fed funds. And then the market wakes up again, just like it did in 2010, just like it did in 2019. The speculator cash comes rushing in. The futures contracts even take off. And I'll give you one last thing, Tom, we haven't even talked about yet. How about the mining shares so far this year?
Well, Craig, let's just put a pin in the mining shares real quick.
Yeah.
The one thing I just wanted to point people to is in the 70s, there was almost three three spikes of inflation. There was one initial spike, and then it came back down, and then it went higher, and then it came back down again, and then it just ultimately took off to its highs. So it's possible that we're in that first deflationary, or that first dip in the road that we have seen in the past, right?
There's that pendulum again, Tom, right?
Yeah, exactly.
Just swinging wider and wider. And the next QE program will be larger than the last. And the inflation problem will get worse because you're starting from a higher baseline, right? Say they get inflation down to 3%, and then they got to start QE again. Then it goes up even higher next time. And again, it is like the 70s. And the market reaction is like the 70s. Again, I don't think there's any way. People try to say, oh, Powell's, the new Volcker and all that kind of stuff. Man, it's just, no. It's mathematically not possible. Debt to GDP, all these different things, total amount of debt versus where we were 42 years ago. I mean, it's just not going to happen. So all they can do is tighten as far as they can until they crash everything, loosen everything up again to try to keep everything going again. And then inflation gets out of hand by 2024, and then they try to play tightening again. And the only question is, does everybody play along again? And oh, yes, the Fed is so credible. Yes, we believe, that'll be the only question. And that's eventually what got out of hand in 78 and 79. And that's why gold went from 200 down to 100, and then back up, and then wider swing to 900. And so again, back to the mining shares. What a very interesting start to 2023. It's been almost every candle's almost been green until maybe today, the 11th. The GDX is up through yesterday. Tuesday the 10th was up something like 11.1% year to date. That's not just you and me and people, buying positions back after tax loss selling, right? That's a pretty big move of institutional, hedge fund, whatever, cash coming into the sector. It doesn't take a whole lot of money. It's a small sector. But to move up that much and consistently, that's a tell too, that there's some smart people out there, not just some dummy out here in Kansas. There's smart people out there that can see this coming. And it's not like the shares, not like GX is going to 40 next week. It'll pull back too. But that kind of move, especially after it already had a 25% run to end the year from 22.5 to 28.5, that type of move is pretty impressive. And that's a tell of what some pretty smart money thinks is going to happen this year.
Yeah. And I think, if that gathers momentum, if and when that gathers momentum, that is just going to end up feeding on itself, because you're going to have these other funds start to look at the gold sector starting to outperform everything else. And then all of a sudden, people that have no interest necessarily in gold say, we're getting our ass kicked by this asset.
Right.
Or the asset
back
class.
To where we started. Patience. Don't get thrown off. Educate yourself. Don't just swallow what your stockbroker or your fuzzy-headed brother-in-law or what the guy on television tells you. Okay, think for yourself. And because if you don't, when all this starts to play out again, you'll be wrong-footed, and then you'll be playing catch-up. You'll be like, well, I'll wait for the pullback, and then I'll start buying some mining shares. And then the train's left the station at that point, and then you're playing catch-up. What you should be doing now is building positions, which is probably what's happening, why the GDX has been moving up the way it has. Institutions building positions. Should also be adding to your stack of physical metal, on the dips. And there's going to be plenty of dips over the next couple of months, that's for sure. But in preparation, again, the historical precedent has been set, just like 2010 and 2019 that led to 2011 and 2020. 2023 is setting us up again for even crazier times in 24.
Well, Craig, I think that's a good place to kind of wrap up for today. We've really gone through a good amount of your report there. Again, if we'll put the link in the show notes for anybody that wants to read it. It's not a terribly long or complicated read, but it's a good read to just kind of go through to give you some perspective for the year here.
Hopefully, I always try to lay it out. It's not designed to be like, some fancy sell side analyst, Wall Street thing. I try to put it, in English in a way that you can connect the dots yourself and see what I'm thinking. And that's that's what I try to do. It's a good way for me to kind of organize my thoughts as the year begin as well, and keep me focused. And so hopefully it'll help keep other people focused. And again, there's a link at the bottom of the page. You can go and find out how TFMR works. And if you want to join us, save yourself a couple bucks, join for a month and use that code 2023 and get half off for your first month and see if you like it.
Mm-hmm. And of course, that's tfmetalsreport.com and at tfmetals on Twitter, right?
That's it. There's 58,000. I mean, what a platform Twitter is. I mean, it's just incredible. I was talking to Jim at Wall Street Silver the other day, and he's got like 500,000 followers. And his, you get these analytics now to show you how many people you've engaged with. I mean, the amount of people watching CNBC or something at any time during the day is like 100,000, 150,000. Mm-hmm. Half of those are stockbrokers who just have it on in their office in the background. And the other half are a bunch of, Adderall addicted stock jockeys on their laptops, right? Where on Twitter, Jim can put out something and it's seen by 200,000 people. It's a fabulous platform for all its warts. If you're not on Twitter, just go on there and follow the financial people. Again, as part of that education, you'll be glad you did.
Absolutely. Craig, thanks so much for your time today.
Always good to see you, Tom. Hopefully we'll do this again soon.
Absolutely. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.